Coming up, Jacksonville multifamily, the new construction pipeline, population trends, and the new normal in the Jacksonville apartment sector. We're diving into all things Jacksonville multifamily with NAI's John Rutherford. But first, a tasty musical treat from one of Jacksonville's very own Firewater Tent Revival.
Who can I blame it on? Well, I'm the only one that can wear these shoes, the only one that can pay these dues.
Hello, Jacksonvillians. I'm your host, Ian Brown, and this is the Jacksonville Commercial Real Estate Show, where we bring you dynamic local entrepreneurs, deal makers, and thought leaders ready to dive in, unpack the local commercial market so you can invest with greater confidence and accelerate your own success. This show is lovingly produced by yours truly and Yield Coach Capital. To stay up to date and never miss an opportunity, go to investwiththecoach.com, answer a couple of questions, and join the team. Today, I am joined by John Rutherford, Senior Vice President at NAI Hallmark's Multifamily Investment Sales Team. John, welcome to the Jacksonville Commercial Real Estate Show.
Thanks, Ian. I appreciate you having me.
I'm going to sizzle you right out of the gates with a burning question. With bridge debt maturities, cap rate expansion, rising insurance, and declining rents, is Jacksonville multifamily heading for a cliff?
That's an intense first question there for sure, but it's okay. It's one that I think I'm prepared to answer. Is Jacksonville heading for a cliff? No, I do think that we have seen a pendulum swing for sure. That's coupled with all the things you talked about on top of delivering more supply than we have on record. But I think the saving grace to Jacksonville, and what I think a lot of investors don't necessarily see behind the scenes, is that the supply and demand aspect of Jacksonville is still incredibly favorable. We've had on average about 40,000 jobs a year come to Jacksonville, new jobs a year over the last 2 years. Historically, from 2015 to 2020, that number was roughly around 20,000. So we've seen tremendous growth. I think it fits the narrative that we've all heard, especially, COVID, post-COVID. People were looking to move from Northeast California, Midwest to warmer climates. There was more work from home opportunity. And Jacksonville being a coastal town that is more affordable than any other major market that still offers some aspect of seasonality with the weather, that attracted a lot of people. And so we're still seeing the benefit of that. And then further to that foundational piece that's going to help sustain Jacksonville, even with all these market headwinds, is that we have a pretty diverse employment sector. You think of an MSA around 1.7 million people, we normally would see, call it 3 major employers. Jacksonville really has 5. And so when you look at that diversity, you say, well, if one sector gets hit, there's still others that are willing and capable of seeing us through that. And we saw that during COVID, especially. Jacksonville saw unemployment increase at a rate just like everybody else, but it didn't go up as high as markets like Tampa or Orlando. Tampa maybe has a little bit more of a tech-based employment sector. Orlando, obviously, tourism. So all those things those employment sectors that are a little less sexy, military, logistics and distribution, education. Those are the employment sectors that allowed us to see this through. And unemployment came down at a faster rate anywhere else than those major markets in Florida. So we were able to really get a good snapshot or case study, if you will, of how that diversity really does help Jacksonville a lot.
Thank you, John. Let's unpack that just a little more. So, depending on what website you look at, Florida is picking up a net 1,200 people a day, and then Jacksonville gets its fair share. What I hadn't heard somebody say yet is what you just said. You said 40,000 jobs each year or the past 2 years, correct?
On average, right?
On average, wow.
We saw a little bit north of 40 in 2021 and a little bit less than 40 in 2022.
Yeah. And I'm jumping around a little bit, but since you brought that up, this supply and demand being in the favor of Northeast Florida, in favor of the Jacksonville MSA. This is a question I had for later, but I think it's right on point. In your opinion, are we heating up and overbuilding? We have a fair amount of units in the pipeline and or under construction. Do you think we're just hitting demand that isn't satisfied, or are we getting to a point where kind of ahead of our skis and overbuilding?
Yeah, I think that's always the concern when you look at markets that are growing in the way that Jacksonville have the foundational components of that. There's always a cycle in that way where developers come in and they go crazy to develop, and then all of a sudden you start to meet and hit the wall in that, and then you scale back from there. Obviously, what's happening in the capital markets is impacting further development. And we see that we've got about 8,200 units delivering this year. That drops down a little bit next year, around 6,000 or 6,500 or so, and then really falls off a cliff, and what we suspect to be less than 5,000 in 2025. So I think that sort of speaks to the narrative of what we're talking about here. But have we overdeveloped? I would say no, just given the overall number of jobs that are coming into the area. We really look at a 6-to-1 ratio as far as supply and demand is concerned. And if you look, the data suggests that we haven't hit that ratio. And if anything, we have a backlog of demand versus supply. So a lot of the supply, I think, is helping to make right all of the demand that had been there from past years. Now, a lot of it is coming online at once. You also, again, are hit with these other market headwinds. So we are seeing developers try and get ahead of the others and offer more and more concessions, which is having a bit of a domino effect. But it tends to be a little bit more sub-market specific there.
And so, John, what's that 6-to-1 ratio? Sorry to cut you off.
Sorry, yeah, that 6-to-1 ratio would be new jobs for every one apartment being developed there. So
gotcha. Thank you.
About 8,000 units coming online. We should have about 48,000 new jobs right now. Again, you have to take into consideration the backlog of jobs. We saw 2021, it was roughly 46,000 jobs that came in, but we only delivered about 2,700 units, right? So you still have that catch up, right? People still have, some need to live somewhere. And you saw that in what happened with rents. Rents skyrocketed during that time, as did most of the Southeast and the Sun Belt. That's where we saw people moving to. But as that supply catches up, rents obviously catch up with it. We don't suspect that we'll see 25% rent growth year over year. We know the market can't support that. So this further development is a good thing for overall market affordability. Creates a sort of just a bit better balance of supply and demand in that way.
And John, you put out a great market report quarterly, and we can talk about this later, but I suggest everybody get on John's market report and email list. I have your most recent one up here. And, I think that what stood out at me is we have a fairly stable marketplace based on your quarterly update. The biggest number that jumped out at me would probably be the roughly 150 basis point cap rate expansion. Is that just primarily driven by the interest rate environment we're in?
Yeah, 100%, right? I mean, it's you look in the last few years, and there's a ton of value add upside on a lot of properties. Jacksonville historically saw the most development in the 70s and 80s. So you have a lot of older product in Jacksonville that is primed for a quality renovation. You have a market segment that has seen relatively good wage growth. In fact, during COVID, Jacksonville was ranked, I believe, was top 4 for overall wage growth at 14.5% year over year. That was in the beginning of 2021. So, and that was really the height of inflation. You say inflation is 8.5%. I feel really good about wage growth, obviously north of that, and even that significantly more north of that. So you have a renter base that's making more money, and they're demanding a better quality product. So we saw a lot of that, a lot of properties trade. And we saw a lot of that be buoyed by, 80% loan to cost, 3% rate bridge, floating rate bridge debt, which obviously is coming back on the flip side here now with rates, call it, 7% on fixed rate today. So yeah, that's obviously pushing up the cap rate there, and deals just can't sustain without, that bridge debt today is probably north of 10%. Right. And so it's really tough. You just can't push rents far enough in that way, especially with more supply coming online. So you have to look for some fixed rate debt situation, which requires more in-place income with a higher debt coverage ratio there. And so it's just a cycle in that way. And we suspect that the cap rates will tick up. But we knew that selling deals at a 3 cap or sub 3 cap was not going to be sustainable for the market for the long term.
And on that topic of bridge debt, you mentioned it could be double digit if you go shopping for multifamily bridge loans, and we're recording towards the end of 2023 here. Is it also, even at that rate, more difficult to obtain, and is it at a lower loan to value?
It is at a lower loan to value. We're still having success on our end with matching buyers with the right debt products, the right debt brokers that can deliver the debt products. We've been able to see even here as of late rates in the 8% range on a fixed quasi bridge product, getting up to 75% loan to cost is probably the best that we've seen out there as of late. But the majority of the market is really north of 10% there. And you're right, it's probably coming in somewhere between 65 to 70% loan to cost today.
Okay. Using the analogy of red light, green light, yellow light, where do you think most multifamily participants' transactional mindset is red light, green light, yellow light as they're looking at this market?
It's probably it's in that yellow light, if not leaning towards red light, scenario there. And everybody has their own investment thesis there of what would make sense, where we think the quote unquote bottom will be. I'm reminded of a quote by Warren Buffett: "Time in the market's always greater than timing the market." And I think that we're seeing a lot of owners that are now understanding of property sellers that are understanding of, hey, my deal has to pencil for long-term fixed rate debt. So I do think that we have seen with those cap rates increasing, basis of deals has come down. And if you can go put a Fannie or Freddie 10-year plus note on this they're putting out some really good IO, I do think that these deals are going to be successful, especially when you look at the foundational pieces of Jacksonville that we talked about already. It being there. So we know that the long-term outlook on Jacksonville and North Florida in general is very strong. And if you have that long-term debt, I think that you'll be successful. With that said, we're still hearing a lot of groups saying, I don't know if we're at the bottom. I don't know if we're at the bottom. We'll see how the Fed lands this thing. I think some are becoming a little bit more optimistic here. We've seen the treasuries dip a little bit as of late. And so if the Fed is able to navigate that soft landing, so to speak, then I think some groups will look back and say, man, I really wish I would have been buying in Q4 2023.
And John, I should have asked earlier, what is your sweet spot in apartment brokerage? Where do you personally like to fall into the marketplace as far as vintage or unit count or all that?
I would say historically, we found a really good niche in helping our clients understand the complexities of a unique value add deal, which historically has been in the 1960s and 1980s vintage product type. However, we sell product type of all vintages and sizes. We pride ourselves on having a team that will sell that urban infill, Class A, Jacks Beach 10-unit deal, and then we'll also sell the 1,000-unit portfolio of distressed value add deal. And we really have created a framework within our team to be able to do that. And really, we recognize the needs of the market. So the market says, hey, we want to be buying more 2000s vintage, light to moderate value add, or if we want to, hey, we're heavy in the 1960s deep value add deals. Our job is to go out there and deliver for our clients and find those opportunities regardless.
Excellent. One thing I used to do, this is going back, it feels like a lifetime ago, is loan restructuring work. And I wonder, this is going to get to a question, so bear with me. I wonder if, as we go into this kind of new part of the cycle where you have some bridge and floating debt maturing, and a lot of people just kind of wondering, well, what's going to happen with these maturities? In the past, like when we're going back more than 10 years, say 2009, 10, 11, 12, many of those loans were foreclosed and the lenders brought them back. And many of them were sold at pennies on the dollar. I feel like there was a lesson learned there. And I just personally wonder if that, well, I'll tell you, I think lenders are going to be a little smarter and maybe offer more restructuring ideas than the last cycle. What are your thoughts on all of this potentially ballooning floating debt?
Yeah, I think that's a great topic to talk about, especially right now. I think that's really what the market's been licking their chops on, knowing that there's all this floating rate 2-3-year term bridge debt or rate caps expiring between now and really 2024, especially, and really waiting for those to come due. We've already started to see some of that out there. And there's been some publications that have talked through some larger loan workouts that have happened already. We've already started to have conversations with lenders in that way to really understand what their pension is. And what we're finding is that you look at the transaction volume of the last 2 years, there's a significant amount of deal flow nationwide, more so. I don't know the stats, but I would assume it's some of the most we've ever seen. And a lot of those deals, especially older vintage, heavy value add deals, were all floating rate debt. And so there's a handful of lenders in particular that were lending on that. Come to mind Arbor, MF1, a few others. They're looking at as a very sizable amount of deals that would come back to them if they're not willing to work to restructure something. And while they may claim that they have the asset management teams in place to take on 10,000 units at once, I just don't see it. And so I think that they're much more inclined, especially to your point of learning from past years as well on their end. Let's figure out a way to work this out. There's a ton of pref equity out there in the market right now that's chasing these opportunities. In addition to groups that are saying we'll come in, assume some role of that GP, and be that true rescue capital in that way. And I think groups out there, lenders out there that have this debt, they're saying, look, if you've got somebody that has a track record that's willing to come in and put some capital into this deal, we're willing to work that out, whether that's we're going to reduce our spread, we're going to give a loan extension, we're going to give a loan extension where the DSCR just shouldn't or isn't. I think that provides some real opportunities for these deals to have the can kick down the road, if you will, to 2025. What we hope will be a lower interest rate environment. Nobody knows. I say a lot to say, I don't think it's going to be the bloodbath everybody thinks it is in 2024. I think we could see something in 2025, depending on how these get restructured. But I think most are confident that with a little bit more time, a little bit more capital, the foundation of these markets is still really strong. There's still a ton of loss to lease capture there. They can execute on that no matter what, no matter where the rates are at. They'll be able to refi into some more favorable situation.
Yeah. And I tend to think, there probably will be some dead fish that float up, but I just don't think it's going to be in the volume that people remember. If you were investing, post 2010, there were just so many properties being sold for just fractions. I personally put together a deal that was built in 2009. We did a DPO in 13 or 14 for $5 million. It was a $11 million build. There were some rooms that it was a new extended stay hotel. There were some rooms that had only been rented a couple times. So it's like a brand new property being sold for like 45 cents on the dollar. I just don't see that. I just don't. That part of why that happened is you had that FDIC loss share agreement where the FDIC was actually covering 85% of the bank's loss. So the bank's only taking 15% of that loss. And I think that led to some resolutions that you wouldn't do now unless the federal government stepped in again. What I'm getting at is we might read the daily record and see some transactions where it's like, oh my God, somebody just stole that property. I just don't think it's going to be in a frequency or a volume that you can have a whole business plan on. I think keep your eyes peeled for some of these opportunities, some of these quote unquote dead fish. I think if you're waiting to just fill your portfolio with those, I'm skeptical as well. What do you see as like the new normal? I don't want to go too far out because the further we go out, it's hard to speculate. I do tend to agree with you on where rates might settle a little more in 25. But, let's say the next 12, 18 months get us through, we're almost into 2024 now. Do you see 24 as like another year with, 20% of the transaction volume that we saw in the previous couple of years? Where do you see the new normal for the next year or so?
It's tough to say. I know that there's a lot of people out there that want to try and predict that, but frankly, I don't think any of us really know. I would suspect that we are going to see less transactional volume than what we had in 2020, 2021, 2022, especially. But could it get closer to the norms of what we saw in 2019, 2018? Yeah, I think so, because I think ultimately more time in these deals, especially in stable markets like Jacksonville and North Florida, it's going to allow you to execute that business plan a little bit more. Again, this is for groups that really have that working capital and that can sustain through that, or have lenders that are really working with them to make sure that they're getting the necessary draws for their CapEx plans and things of that nature, or amending them as they see fit as well. I think those groups that have a little bit more time are going to execute on that business plan, and then it truly is time to exit. And I think that there will still be some opportunity. Now, I don't think it'll be the 50, 60 IRRs that we've seen in previous years, but I think that there'll still be some good singles and doubles out there. And I think given the current climate, a lot of buyers over the past couple of years with floating debt are going to be happy with that. It's going to set up the deal for the next borrower to have that fixed rate debt, and hopefully keep deals on a little bit more stabilized front going forward, so we don't see that crash and burn. Because ultimately, if we do have that crash and burn and all these deals go back to the bank, they undoubtedly get distressed, right? You get low occupancy. There's a lot of deferred maintenance. We've got to start that value add cycle effectively all over again, and it just takes a lot of time for the city and those submarkets to really continue that improvement. So it's important that that continues on.
And you hinted at something that I tend to agree with, and I've heard before, is we might just be in this environment that feels a lot more like 2018, 2019, kind of pre-COVID spike. And I don't know, those go-go COVID days, that 2021, now in retrospect, a lot of people see 2021 as kind of a high water benchmark. And when you can borrow money, I mean, multifamily, some people were getting loans below 3, and then you couple that with tenants that are getting, bathed in stimulus. It was just an interesting time period that I don't see how, if you're waiting for that again, I just don't see how it would happen. Right. But like to your point, the 2018, 2019 variety of transactions with like value add that you actually have to march through a business plan. Like you said, you're not hitting 3 times equity multiples in 18 months with like a managerial lift.
Right.
Yeah. I'm thinking about buyers and sellers right now in today's market. And I was, as you're aware, I have an 83 unit C-class apartment. And, what are some things that sellers can do? You don't have the people lettering you, cold calling you, texting you, LinkedIn messaging you. When I say that, I mean myself as an owner. We're not getting that frequency of inquiry that we were a couple of years ago. What do you see like a good action plan for a seller right now, kind of in today's environment?
Yeah, I think the focus is really on operations right now. I mean, it's more important than ever that the deal is set up well for an agency or some type of fixed rate loan, which is going to have a higher DSCR requirement. So really the focus on in-place income is the most important. So making sure that you have your bad debt in check, making sure that you're rolling out the ancillary income opportunities that you see other comps doing in the market. Those are going to give you the best opportunity to to not only hit the best price, but have the widest buyer pool in that process.
And I know I was thinking about like requoting insurance. Maybe if you haven't done a cost segregation, try to keep some more money in your pocket. A lot of properties have not been ripe or appropriate for a tax appeal, but I do think that depending on your jurisdiction and your assessed value, maybe a tax appeal, kind of going line by line, working through everything that we just talked about. Well, you flip the script to like a buyer right now. It's an interesting time. You have 80% of the competition is gone. Just if you look at the transaction volume being, let's just call it 20% of maybe where it was. You could be swift-footed. You might be the only one out there making offers. What do you see as a buyer's action plan right now?
I'll tell you, I still think that the overall buyer and offer activity is there. Whether groups are really actively pursuing that, that's a different story. But I would say depending on the broker, a quality broker can still drive 10 plus offers on a property. Now the differences are those 10 plus offers where the seller's expectations are or not, right? So I think it can be a really good way to understand where the market's at and maybe identify a couple of outliers to really work towards executing on, right? Obviously, a 1031 buyer still is going to have added incentive to maybe pay a little bit more than market for a net win-win there. But outside of that, I would say, sorry, can you repeat the question?
Well, I was thinking about, we talked about the action plan for a seller in today's market. And it's like, okay, well, let's say you're a buyer. Maybe you still want to grow a portfolio.
Yeah.
What's a good action plan for a buyer here at the end of 2023 going into 24, to kind of outperform?
Well, yeah, I think it's really, it still comes down to being diligent towards the underwriting model that you have. I think you'd really have to maybe look at that and say, is it still realistic for me to assume 20% plus IRR, or are we back in a low to mid-teens IRR environment? Do I need to be chasing double-digit cash on cash for a deal that's had some good value I'd put in and capital put into it over the last couple of years, or is a 6 to 7, 8% cash on cash over the lifetime of the hold, in play there before, of course, any capital event? So I think that's the first thing. Reassess that, and obviously that's a big part of that comes back to your investors and educating your investors on where we're at in the cycle in the market. But if you can get your investors on board, or if you're a high net worth individual that has that capital to do deals, I think it's reassessing that, hey, look, those are still really great returns, especially you factor in that we're in a bonus depreciation environment, even still, that there's still money to be made in real estate. There's a lot of benefit in owning real estate versus other areas of investment opportunity. So I think that's the first thing. Second, from there, I think it's really fine tuning your operational approach. So now's the time when vendors are a little bit slower to make sure that you have an understanding of what does a roof replacement cost? What does a repipe of supply water lines on a property cost? So that way you're able to act quicker and faster when you're going in and reviewing a deal, making sure that, hey, this deal works. And now is the time, I think, to get a little bit better pricing than what we've seen in the last couple of years, especially if you're going agency debt that's not going to have that CapEx funded up front for you.
I was thinking too, for the past few years, a lot of buyers or like newer capital groups, they've been running frantically, doing deals or writing offers and underwriting. Now's not a bad time to replace that 10-year-old headshot, to get rid of that Yahoo email address, to kind of work on your pitch deck, work on your website, work on your presentation. I wouldn't take this as a time to just put your feet up. I'd take it as a time to work on like your personal development and your professional development. So, you can get out there and outperform the people that might get complacent right now.
And I'll say that, yeah, 100%. And I think surety to close is more important now than ever. I know we've always talked about this, but it really does have more of an onus in the deal, and perhaps even more so than price. I know we've sold deals in this year to buyers that weren't the highest as far as price goes, and that really did execute well on their buyer questionnaires and did have their debt and their insurance lined up truly up front. They had their equity in place. And I'll say maybe an unpopular opinion of this is that if you're truly looking to scale a lot in 2024 and 2025, going and looking at that deal that doesn't quite pencil in the way that you want or needed to, or go buy that smaller deal where you don't have to take on as much in investor capital in that way, and frankly, pay up a little bit for it, right? So if you're saying, man, this deal is only going to be a 4% cash on cash deal for me, so it's only going to be an 11% IRR. I challenge you to go do those deals, because what's going to happen is you're now going to have a case study to say, I executed a deal with crazy market headwinds. Brokers are going to take notice of that. Owners are going to take notice of that. You're going to pop up on every deal list out there, even nationwide, say this group, this guy, this gal is still executing out there in the market. I guarantee you your phone's going to start ringing a lot more with deals, and not just deals on market, but off-market deals that maybe didn't hit. So if you end up paying up and not seeing that full return on that deal, I guarantee you that you'll see it on deal 2, 3, 4, 5 that are going to help you scale.
Very good point, John. All right. Before we, started to air this episode, we were talking about how you and your team, you're almost like an additional partner in a way to your buyers. And you take your clients on the buy side through a deal as if you're, a board member, so to speak. Let's talk about a deal breakdown. Typically what I ask is, of a Jacksonville deal. So what was it? How'd you find it? How'd you fund it? What made it an opportunity? What'd you do? How'd you exit? And were there any takeaways? I'll repeat all that. But if you got one for me, John, what and where is a multifamily deal that you took a client through recently?
Yeah, I would say we've had success this year. Obviously in spite of what's going on out there, and in large part, I think it is because we really do align ourselves with both buyer and seller in that way, and really work to just unravel that added value that sits out there. And that's through a lot of effort. It's through a lot of different relationships. One deal that comes to mind, we closed here this year. It's a deal called Park at River City. This deal is really unique in the fact that it sort of just sat frozen. And I say that specifically all throughout 2020, 2021, 2022. In the sense that rents did not move for whatever reason. This deal was bought in 2017, 2018 at an amazing basis. The framework of the deal is really strong, concrete block. Most units were townhouses. Location was strong, good access to retail and employers and highway and all the things you look for. But a 60s vintage deal that they just simply didn't execute on that business plan. And frankly, they didn't really have to. They moved rents enough to still cash flow well. They move rents enough to still see a nice return on exit. And we saw a lot of groups that operated in that way. We still saw a lot of groups that took advantage of the 20-25% rent growth without really having to do anything in 2021, 2022. For whatever reason, this deal didn't. So the issue going with this deal was that it had average rents less than $1,000, where the market was probably around 1,250 to 1,300. So part of that is when you're chasing agency or some sort of fixed rate finance and that going in DSCR is higher, they're really digging down on that in-place income. This deal did not have that. So we were looking at a lot of different avenues for what can we do to figure out to some sort of a bridge solution that was fixed. You didn't have to pay a rate cap up front. And we discovered this fixed bridge solution that was about 200 bips lower than everybody else. They didn't have a rate cap purchase. The prepayment was essentially nil. Full term IO, a couple of extension options. Further to that, we knew that the insurance was going to be really difficult as well. So we took it upon ourselves to go out and start working and getting insurance quotes. We knew that there were some strategies that we could deploy working with specific insurance brokers to find one carrier in particular that was going to give us a really great quote. And this was really important because in our marketing process, we had, unfortunately, a fire that took out 8 units, which this deal was only 104 units. We had almost 10% of the property down. There was already 1 down unit on the property from a previous issue. So we had 9 total down units. We knew that in the state of insurance that would be a real big killer. We were able to execute an insurance quote for this buyer at roughly $1,150 a unit, where frankly the market was coming in on this around $3,000 a unit, given that large 7-figure claim from 2 weeks ago. So I think being able to go out and source solutions like that up front, being able to go out and help buyers with those rent comp surveys, and our team doesn't rely on a CoStar report for rent comp survey. We specifically call and/or shop every single rent comp, and we truly are looking at similar vintage, similar square footage, making sure that it really is an apples to apples comparison, because we know how much that drives the upside there. And then beyond that, doing an analysis of that rent roll for them, helping them understand where rents have gone, what specifically has been done to these units to help push there, and where we feel based on comps or even what the property has done, where strategic capital can be placed in these units to drive rents the fastest. So we know that this deal, even on a loss to lease standpoint, is going to have 40 to 50% rent growth. I think that's pretty compelling. Ultimately, the property ended up closing cash because the buyer said, "Hey, look, this is even at rates in the 8%. My cost of capital is less than that. Let's go out and deliver that same return for me, along with the upside." So that was one that had some hair on it, so some challenges. We were able to overcome that in large part by thinking through what those issues could be and providing those solutions up front.
That's awesome. So, and I like you brought up some interesting points. You had to solve an insurance issue. You also had a property that, because of your expertise and you were actually playing apples to apples and doing true rent comps and looking at the comparable set, you realized this property never bumped their rents up those 25% years that had come subsequent to their previous acquisition. And so it was almost like you walked them through a combination of this kind of like white collar managerial value add, coupled with knowing like just the right vendors. I'm not that familiar with this you called it a fixed bridge product. So I don't want to divert, but I assume that's like a loan to cost product where they'll fund CapEx in a fixed rate. Okay, perfect. And, the opportunity, I presume you probably found it through your hard-earned, well-deserved network, getting to know all these local Jacksonville owners, correct?
That's it. 100%.
Awesome. And what would you say the lesson or takeaway was from that deal you did this year?
I think the biggest thing is not letting the market decide it for you, because we know that how many headwinds are out there in the market right now, and just letting things fall into place, as it were, which a lot of us were able to do over the last couple of years, buyers, sellers, brokers alike. But being able to really underwrite the deal hard up front. I mean, I'm talking look at every single cell, column, row on that financial statement, question every bit. And that's a big aspect of what we do up front as well. We try to anticipate the questions that not only will a buyer have, but what will a lender have as well. Let's get those debt quotes up front. Let's get those insurance quotes up front. Let's anticipate those problems. Work really hard to get these solutions in place, because likely even the solutions you work to get in place are still going to have hurdles. But if you can at least anticipate those, you can be on your feet a little bit more. So when that does happen, you're more prepared to do that. Otherwise, you're going to get hit with a problem in a last second scenario. You're not going to have enough time to work out a solution, and the deal's going to fall apart.
All right, John, we're going to bring it into some closing questions, and they're fun ones. You know what? I love them. So the first one, why do you love Jacksonville?
Oh man, this hits close to home because I purposely chose to move back to Jacksonville in 2014, and I had to ask myself that question specifically. I was living in Dallas and in Atlanta and traveling throughout the Midwest for work, and a lot of bigger cities, bigger markets. And I asked myself, if I'm going to go back and broker specifically in these markets, why not go to a perceived larger market, Dallas, Miami, Atlanta, et cetera. What I ultimately determined with Jacksonville, one, I'm from here, right? Friends and family, and that ecosystem is important. But beyond that, we have an amazing landscape here, coastal town, great outdoor life, great weather. Cost of living is better than what you'll find in those bigger markets as well. And then just the growth opportunity. We have more capital flowing into Jacksonville now, even in the current climate, than we in the history of Jacksonville. We have roughly $4.5 billion of projects planned in downtown, which will very soon be the heartbeat of our city, even that much more. So it's just very exciting to be a part of, especially when you factor in all those other personal reasons.
I've said it before, and it just bears repeating. I feel like, and I'm from Jacksonville as well. I feel like in Jacksonville, it's like not all the seats are taken. Like you can come in here, you can make a splash. It's just a lot of things are up for grabs for someone like yourself and someone who's willing to get in there and do the work. This is still it's a large and established market, but it's emerging, and there are room for people to come in here and have success. And I just love that.
I think if you look at even the latest announcement, the Gateway Jacks project is a $2 billion initiative in downtown. The local group JWB, they bought up 12 city blocks, 13 city blocks downtown. I mean, for an MSA of this size the city that has this much going, that's pretty rare. You don't go into most major cities and have the ability to buy that much scale in what again is viewed as the heartbeat of a city. So I think that just speaks to the remaining opportunity that's here and that we get to be a part of.
Yeah, love it. All right. What's your favorite local restaurant?
Oh man, this is while I think the culinary scene in Jacksonville has grown up a lot over the last 5 years. There's one restaurant in particular that I think is Michelin star without the Michelin star, and I'm going to say that's Rue Saint Marc in San Marco. If you've had the opportunity, and I'm sure you have, to eat there, they have a tasting menu. The best by the glass wine list. They'll pair the wine with the meal for you. It's first class service, amazing attention to detail, and frankly at half the price that you'll find in Manhattan or Miami.
All right, Rue in San Marco.
Rue Saint Marc, yeah.
Rue Saint Marc in San Marco. Awesome. All right, a local business that people should know about.
I'm going to be a little bit biased here, Ian, and I'm going to say Bernie's Wine.
and why are you biased, John?
I had the fortunate opportunity to purchase that business in the COVID year. We looked up and said, "Hey, where's their opportunity?" And guess what? People love wine, especially in a COVID environment. So. Yes. No, it's a great local business. It had a really great foundation. Bought it from a gentleman named Bernie, who is viewed somewhat as a wine demigod here, and he's still very much so a part of the operations. And it's a little small boutique shop, 800 square feet, but we've got about 350 wine SKUs, and try to put a lot of wine that you don't typically see in a Publix or Total Wine there. So would love to help out anybody who's looking for wine.
And where is Bernie's located?
Yeah, this is in I think what most would consider a majorly gentrified submarket of Jacksonville called Murray Hill, next to a bit of eclectic brewery and bakery and coffee shop possible. So it's a really cool setting right next door to a cheese and charcuterie shop. So for added appeal.
Awesome. All right. Who's someone you've met locally, someone making interesting moves, who you think we should reach out to and maybe get on the show?
Man, I mentioned the Gateway Jacks project. I mean, you think about the guys at JWB and the passion that they have for the city and the projects that they're doing. Not only I think that big project gets a lot of talk, but they've really been a big proponent of Jacksonville for a long time. You think about all the they started in the single family world, and then started buying up the commercial that has a direct impact on that, and really looking to benefit communities beyond just make a dollar. So they stand out to me there.
I love it. We're going to reach out. All right. I look forward to your Jacksonville multifamily quarterly report. I mentioned that at the top of the show. Where can people connect with you? Make sure they get on that list to get your market report and learn more about you.
Yeah, send me an email directly, jr@NAI Hallmark.com. That's the best way for us to connect, hop on a call, get to know one another. You can go to our website, NAIHallmark.com, to sign up for any one of our lists. We offer brokerage services beyond just multifamily. Our team focuses on multifamily, but we have an office, industrial, and retail team as well. Property management for all those third-party services too, with exceptional multifamily. So hopefully some added appeal beyond just the market report too.
John, thank you so much. And everybody, you need to do that. Reach out, email John, get on his list, connect with him. He's a great guest. All right, John. Well, thank you for making the time and coming on the show. We'll have you back in 2024.
Awesome.
And guys, please follow, rate, and review this podcast and share it with a friend. It makes a huge difference and allows us to bring you quality guests like John Rutherford today. As I mentioned at the top of the show, to stay up to date with us and never miss an educational, networking, or investment opportunity, go to investwiththecoach.com, answer a couple of questions, and join the team. If you're into scrolling and you want to look at our personal and professional lives, check us out at Yield Coach on Instagram, Facebook, LinkedIn, and YouTube. But for now, that is a wrap on this Jacksonville Commercial Real Estate Show. I'm your host, Ian Brown, signing off and reminding everybody to lace up and leave it all on the field. Yield Coach out.